most of your audience thinks creative financing is where the seller has free and clear property and they're going to owner finance the whole price of the property. That's kind of, they've labeled that as seller financing. In the next few years, if history repeats itself, and I believe it certainly will.
I do as well.
75% of notes created will not be a first lien. The seller will carry a second lien or a third lien. And so I'm teaching people how to reach deeper into their opportunity pool and find out how to go do things in various ways. You know, like there's a very small second, right? That's called a piggyback second. Now that might be where a seller doesn't get any interest or payments for a period of time, could be 10 years. They get their price, but they have to wait for part of their money. Then the seller might carry, say, half of the deal, right? Seller finance half of the deal, and you get other financing for the other half of the deal. So call it a 50-50 deal, 50%, lender money and 50% seller finance money, right? Then you have where the seller would finance all of the deal or most all of it. That doesn't mean necessarily you can negotiate it with zero down every time, but he'll negotiate and carry more of the financing. So now all of a sudden, if you look at it, instead of making that one window where seller finance would work, now we've built two more paths where seller financing really could be effective. You could, in other words, you're taking your customer down more paths that are possibilities that the seller could give, very favorable terms, which are better than the market's offering.
Mm-hmm. Now, let me say one thing, because I think if you look at history and you look at where we're going here, I think you're spot on. But I think there's going to be one Hail Mary, and I don't know if it's a Hail Mary even, one difference, which is going to play into your advantage and every one of your students' advantages in such a massive way. When you think about money just as a whole, and that's a lot of what creative financing is, people are going to have to they're forced to use money a different way, to view money a different way, because the traditional way doesn't work. And that's where we're heading, because we're so used to these low interest rates, this cheap money, this abundant money. Now that's going to start to go away. The Fed will make sure that goes away by raising rates and pulling a lot of the money back out of the capital systems. So that's going to, revisit the 80s, so to say, like you mentioned earlier. Like people this is just going to become the norm, seller financing or, whatever you want to call it. But the one thing that you used to have to, your competitor, if you will, you had to fight against is back in the day in the 80s, banks, traditional banks in savings accounts were paying 9, 10, 11%. Those days aren't going to happen again, because the Fed doesn't want banks to lend money out like they used to, because the Fed has now said, hey, banks, give us your surplus money. We'll pay you an interest rate guaranteed on that surplus, so you don't have to lend the money out. So people aren't even taking note that their savings accounts, while the Fed has raised rates all year long and will continue to do that at a tremendous rate, no one's savings accounts paying them more. Their money markets aren't paying them much more than it was a year or 2 years ago when rates were almost zero. And that trend will continue. Yeah. Banks have so much cash that they don't need our deposits. Therefore, they're not going to pay for them. So now when people are looking at their safe money and they're looking at how they're going to make a return on it, there's risky assets, stock market. That's going to, pretty soon, people are going to be scared to death of the stock market. And that trend, that sentiment will continue into the next, I would say, 5 years easily, where people are fearful of stocks because they're going to get so beat up here. So then they're going to go to safe assets, which are going to be bank accounts and CDs. But now they're going to find that bank accounts and CDs aren't even paying enough where they can live or even afford to keep pace with inflation at whatever level inflation's at. So they have to make some serious decisions. How are we going to live? How is our money going to actually earn us a decent return that can even just keep pace with inflation? Eddie, you might be one of the only choices out there outside of some of the stuff that we teach with infinite banking, but there's not going to be a whole lot of options. They're not going to have that, I'll just keep the money in the bank and get my 10%. That's gone.
Yeah. Back in the day when the banks were doing that, they call those hot deposits. Mm-hmm. And banks would need to raise money. And so they would offer higher CD rates than the other banks. Those were hot deposit banks.
I remember those when I was an advisor.
Yeah. And so you're right, they did that. And the trend today is very different. Here's the thing about it. You know, flipping houses when basically Wall Street was buying a big percentage of these houses, right? Flipping houses became really easy because, quite honestly, Wall Street was paying more than fair market value. It seems crazy, and how'd they do it? Why'd they do it? They were doing it because they were securitizing rentals like they used to securitize mortgages back in prior to 08, right? That's exactly what it was. They became very good at doing these securitizations, and they were securitizing rental properties and rents like they securitized mortgages. So that's why they were doing it. It seemed crazy, but they were buying the inventory and they could make so much money doing it that they could essentially overpay for the inventory because they had such a back end strategy that the average person didn't have. Now, all of a sudden, the Wall Street money, of course, has left the market or left the price they were paying in the market. A lot of them have totally exited the market. And so now, all of a sudden, you have to pay a lot less if you're going to flip a house because your exit is a lot less, right? Buy low, sell high, or you'll sell high as it's selling for a lot less than you were. So then you get into the resistance factor of customers. And people talk about this a lot. My customer is still dealing with a Wall Street Journal of 9 months ago. And so they don't realize the market has really had all these things happen. So understand that the creative financing is, we're not trying to go tell people not to go pay cash for a house if customers won't accept a discount price. What we're saying is, what do you do with the customers that don't? Right? What about if you get 1 out of 20 people, Chris? I assume that's a good number. Most people say it is. 1 out of 20 that'll take your cash price. You're turning 19 people off, right? You're turning 19 people away and saying, "I'm sorry, we couldn't do business." What if you could only convert one of those 19 into a creative offer where the seller participated and carried some terms for you? Now, how are you going to make money? Right? Well, you could flip the house with favorable financing in place. That would be one way. Somebody else would buy it. If you have lower than market rates, part of the value of your real estate deal is the way you structured the financing. So you could flip that house off and somebody else would buy it. You and I know people that would rent them, right? Now, some people, particularly out west at the moment, their market's really gotten hit hard and dropped in value. So they're not so rental market driven at the moment because they've seen a pretty significant decline in real estate values. That's pretty much a truth in most of the Western markets. And people say, "Well, I'm in the East. We're different over here." Right. So some people think I still want to do rentals, and I'm fine with that because if you can structure a debt service at below market price, it doesn't matter. A strategy I love to teach is how to go resell it on a wrap note. If you got low cost of financing, then you go sell it and you charge more for your financing than you had to pay for it. Isn't that what your bank does, Chris?
That is.
Don't they take your money in and then loan it to me and charge me more?
100%. They make a spread.
So you talked about credit. You talked about the financial markets. You know that the mortgage origination business in that industry is in real distress times.
Oh, it's down more than half.
Yeah.
Which I don't know if in history that's ever happened this quickly, as a matter of fact.
Well, it's not just that their volume is down, but their margins are down.
Yeah, see, I don't know.
They're not making the same profit on the loan they were making that they were making back when they were doing so much more business. Anyway, there's lots of issues there. We could do a 2-hour show about that. Here's what a lot of people don't know. People think that the mortgage origination business is so off just because of high rates, right? In other words, you were paying 2.5% for a mortgage, and now you're paying 7.5%, right? That's crazy, right? But it's a deeper issue than that. We're in an affordability crunch right now.
Oh, big time.
But we're also in a credit crunch. So the Mortgage Bankers Association has an index the mortgage availability index, meaning who can qualify for a mortgage. So they have this scoring system. So if you just the math will make sense if you don't understand all the details of the scoring. And I'm not even sure that I understand every point of the scoring. Before the virus, the score was 185. Okay? In other words, that's the threshold of mortgage underwriting guidelines. Today, that number is 100.
So that means a lot less people are getting mortgages or able to get mortgages, correct?
You're scaring the heck out of 50% less.
Yeah.
So understand that people say, well, if I seller financed a property, could I find any good buyers? You don't think the mortgage industry's left anybody behind, do you? Like self-employed or people that don't earn just a W-2 salary, that, you know, somehow they're paid on a bonus or a commission or this.
Yeah,
or
people
that.
just like me.
You and I.
That's correct.
And so understand that. So this opportunity to do this becomes incredible right now. And here's why selling on a wrap note could make some sense. First of all, you resell it. The average down payment of a conventional loan is 20% down. So there's a myth that that's not true. The average down payment of a conventional mortgage is like 19.6%. So people will walk in and pay a good down payment. You do not have to sell somebody with seriously injured credit. That's kind of a myth. I can only owner finance to people that are really got big problems. No, that's not true. So then all of a sudden, think about it, Chris, you get a down payment and that's money today. But you create a loan that where you earn a cash flow for a long period of time. And all of a sudden you're in the real estate for what really should have been the real reason you entered it to start with, which is look at your wealth model.
Right. Too many people trying to get rich, not enough people understanding what wealth is.
Great point. So that's why people, that's an advantage that the market has for us, is that the quality of people that need seller financing today, the quality of the borrower is excessively better than other markets in the past. So we have a window of opportunity to solve a problem for people. You know, they say that's how entrepreneurs do really well, is solve a problem other people can't solve, right?
It's the only way. And that should be every entrepreneur's single solitary mission with their business and their life.
Yeah. So here's what we did. We went back and looked at things that we made in art, right? And then we looked at literally thousands of transactions and we patterned them. And then we built paths so that you didn't have to be Eddie Speed with, you know, kind of all the experience and structure and deals and stuff. And we developed paths that people can, like, if this customer falls under this category, then structure a deal that would be like this. And we've picked the best of the best things that we figured out people are willing to accept. The sellers are willing to accept terms. And then we just selected those into what we call decision tree paths. Because once again, what people needed is a simple way to start the process.